How's everyone doing out there? Hope this has been a good trading week, certainly an exciting one. Seeing some new all-time highs, seeing SPX get up to that 5100 level and make a push above, and seeing interest build above there to this 5150 level in SPX, where now we have that wall of calls above, and there's a large area of resting liquidity on the offer just above there as well. I don't believe in coincidences in markets. I am one who believes options do play a big role in price discovery, and I realize that view for some reason is somewhat controversial. Although, when we use a data-driven approach to qualify what's happening in markets, it's not controversial at all. Options play an enormous role in price discovery. In fact, about 1.2 trillion of notional trades hands every day in SPX alone. And that's greater than all the equity futures contracts from the U.S. equity indices on the CME combined. They trade about 400 billion a day. So there's a big difference. There is a big difference. So it is kind of the tail that wags the dog. I do think it's something that warrants further discussion, but that's also why I built the tool that I did to kind of look at this stuff and say, okay, well, let's qualify that a little bit more. And so we can see on screen, we've got the SPX options visualizer on the right-hand column, and we can see we've just kind of been stuck around this most active call strike, briefly breaking above, trying to push above this resting liquidity, and then just getting magnetically pulled back to it. This is another area where you can see options exert an almost magnetic influence. So I'm zooming out to show how this has happened throughout the day as well. And now the point of control, first it was pulled up to what was at that point the most active call. Now it's been pulled up to the new most active call. So we can see buyers also taking control, and that coinciding with the levels we're seeing in options. Just like there's a large level of resting liquidity at the most active put, strike, and then also around this key level of gamma exposure. I look at all that and say, if market participants are expressing interest in these levels and we can see convergences across resting liquidity and options positioning and flow, then that's important to take into consideration for my trading process to understand where extensions may go. It's a little more scientific than using Fibonacci to actually look at where interest is, right? So you get an opening range breakout. Where do we target our core? Where do we target our runners? Well, now we have levels of interest that we can see where there's convergences in both options and in limit orders above. So that helps. It helps to take some of the guesswork out, and we can be a little bit more scientific in our approach by taking all the information the market is giving us and processing that into how we're trading, right? I find that to be quite helpful myself. And so we see this in Bookmap. It tends to be that SPX has a big influence on ES. It tends to be that the options trade in SPX, it kind of acts like a magnet for ES in terms of where price is going to go. And that has to do with when you look at the total amount of options that are trading on SPX, some amount of that is going to be hedged in ES. It's going to be hedged in S&P futures by market makers. So there's a direct footprint there that does have a directional impact on price discovery. But don't take my word for it. Go out and do some research yourself and qualify what I'm saying, because the research is out there and it says the same. And I'm not just talking about 0 DTEs. I'm talking about all the options across the SPX chain, of which there's about 10,000. Now, I look at that data and I reprocess it every single minute for the way that I'm modeling this out on my tool here. You've probably seen the charts that I posted out on Twitter as well. That goes from that same model of exposure. And I think it's helpful for us as traders to just contextualize all the different forces that are moving the market and have one easy place to see that. So that's why I built this into Bookmap, because I already really like the resting liquidity and where we've seen transactions happening in one place. The way they put it on screen is pretty helpful to me in that heat map. But the only thing I always felt was missing was those options. And now being able to see that helps. And I'm actually going to build that out for SPY, Triple Q, NVIDIA, and others, so that if you're trading, ETFs and single stocks with Bookmap, you'll be able to see that in additional add-ons that I plan to create as time goes on. But let's check in on the NASDAQ here, our favorite high beta cousin, seeing a little bit of a draw here from its highs, pushing below the point of control. And now we see a relatively large resting bid below. We'll see if that acts like a bit of a magnet towards price here. Often it does when the trend is your friend. And we do see this sort of microstructure trend reversal, right? They had their high, Then we had this lower low, lower high, new lower low. So you could say maybe the NASDAQ is starting to see just a bit of distribution here as we close out the day. Russell, quite a similar look in that one. Really starting to pull here. Let's see what it looks like when we zoom out. We do have a similar kind of larger area of resting liquidity below, but the Russell tends to trade in this sort of band, and we're seeing that here. Gold, pretty impressive move. I still want to crack 2100 on a closing basis to have greater confidence about where this thing can go. But I do think that the move we see today suggests that silver, gold miners, other components of that precious metal sector could get a bid here. So I'm really looking at this with interest, particularly if we can close above 2100. Crude, wow, you know, this has been a real mover. We did get up to really about 80.85 today before we saw a bit of a reversal from those highs. But I really like crude above 79 and change. I've been writing about this. It's still above that level here. If we can close at 80 or above, I'll be looking for this thing to extend to the mid 80s. That's really what I'm looking for with the strength we're seeing in crude and the sort of consolidation we had over the past several months. And now we're starting to break out, right? I'm going to put a chart on screen so I can show you exactly what I'm talking about over a longer time frame. I think that's helpful just to kind of contextualize this. So give me 1 second. I'll bring up my trading view chart and you can see what I'm talking about right here on screen. Okay. And I'll put this up here so that everyone can see. So here's crude. We're going to zoom out just a little bit, pull this down a little bit. And you can see that I've been watching this for a while. I've been marking out key areas of price action. And we broke above this value area pretty decisively today. We seem to have room for an extension in this area of lower volume. And we seem to be ready to start to build up to those mid 80s. That's what I'm really looking for here. I'm really looking for crude to continue its journey higher. And, you know, as we see that, I'm also looking for potentially the 10-year to move lower. Now today it's doing the opposite. It's kind of giving us one of these counter trend pops. We'll see if that has continuation in the next week. But typically crude and the 10-year note move in opposite directions. So I'd be more inclined to think that crude in the 80s and above is likely to push 10-year yields higher. So that's why I'm kind of looking at the two with some degree of attention and saying, okay, this is pretty interesting here. Maybe this is an opportunity to fade the 10s if crude has staying power, right? That's been a trade I've favored because I do look for rates to start to rise as we recalculate the resolve of the Fed, the durability of this economic expansion, and some risk that inflation could reaccelerate. So Reddit is planning to price their IPO between $31 and $34 a share. We had a pretty cool discussion about this on the Discord. If you missed it, you can always check out the recording of Thesis Thursdays for Traderade members on our website, where Aisha went through the pros and cons of the Reddit IPO and did a really good job talking about the things to look out for folks. I think personally that it's an interesting company, but I'm not inclined to want to get involved with it. You know, IPOs, they tend to have like a lockup period, and after things get locked up, you see a lot of people cashing out these gains. I don't think Reddit's going to be too different in that respect, so I'd be kind of just looking at it from that perspective with a little bit of side eye. But after that lockup, if they can actually become profitable and improve their growth, maybe it looks more interesting. So let's take a look back at the S&P 500 here. We are seeing a little bit of a draw. We did have the point of control pulled up just below that hot call, and that served as resistance. And there's been some folks on the Discord trading that resistance pretty darn well, making some money on that because, again, you know, if we have these data points and we can lean into them, why wouldn't we? So we can see that liquidity above was an area of resistance, as was the hot call level. Now we're being reflected lower. There is a bit of a magnetic effect around this worm call level as well, where there is some resting liquidity below. So perhaps we see a little bit of a draw down there, and then we get a better sense as to where price is heading as we get into the close. Let's take a look back at the NASDAQ. Seeing again that same pattern of lower highs, lower lows. So that microstructure trend reversal, something to take into consideration as we are in that last hour. And I wouldn't be too surprised if some folks want to take a little bit of profit before the weekend. It is also the beginning of the month, though. So one thing to take into consideration is you have those countervailing flows. You've got, institutions doing allocation. You've got that options decay flow, those Vanna and Charm flows starting to come back in. And we have seen skew on the rise. So there is some degree of hedging. We've seen that in the NAAIM data over the last 2 weeks, where there was more interest in downside protection as well. Now, these guys are very long. Managed money across every measure we look at, they are very long, but they're actually beginning to appreciate the attractive pricing of hedging as downside insurance. And if folks have questions anywhere, feel free to let me know. I'm always happy to discuss, what you're seeing on screen, or if there's other things you'd like me to look at or talk about. This is fun for me. I enjoy sharing. I'm all about trying to help and give back. I was fortunate enough to have, about 19 years of experience under my belt trading going into this, and I'm trying to help other people kind of skip some of the bumps along the road that you have. A wise person learns from their mistakes. A wiser person learns from the mistakes of others. So we got more Fed speak coming up with Kugler. There's supposed to be a live stream on that. That's something that just heard over the squawk. Don't think that's going to be too much of a big deal, since it's not really. We've had so much Fed speak this week, and they really haven't said anything terribly surprising. Let's recap some of the big picture news that we've gotten. I've been covering this as it's been coming out, but I feel like it's probably decent to talk about as well. So going into next week, first the bullish views, January core PCE inflation in line with expectations following a rampant inflation concerns on the back of hotter CPI and PPI prints. More headlines about consumers pushing back on price increases and aiding broader disinflation narrative. So we're seeing some more, people getting a little bit more interested in the idea that consumers are pulling back. They don't want to spend as much on things that are expensive, and that could help disinflation. Tech momentum is continuing, with the sector seeing the biggest inflow since August, and inflows annualizing at a record near 100 billion. AI proliferation of secular growth is broadening now, with Dell post-earnings surging. And, Micron product, a new announcement from them, commencing in a rally as well. And NVIDIA continues to outperform, trading well above its $2 trillion market capitalization. So, we still have a lot of excitement. Semiconductors are on fire today. That's kind of the bull side of it. The bear side is that core PCE inflation rose at the fastest pace in nearly a year, and Supercore reading the fastest of this cycle. And it pushed 6-month annualized rate back above the Fed's 2% target, with more concerns about sticker owners' equivalent rent inflation following BLS email about changes in the calculation methodology. So on the other side of it, there is still some concern about inflation, and we have had surging inflows into tech. Those have been some of the biggest inflows we've seen in a long time. There's a lot of excitement in the space. That excitement is continuing, and it's largely in the services sector. And the manufacturing sector, not so much. February ISM manufacturing down 1.3 points to 47.8, missing the consensus of 49.5, going back into a state of contraction. So we do see the goods industry continuing to slow, even as services remain robust. Finally, we had a lot of Fed speak today. Governor Waller, in a speech today, said that given the overnight reverse repo take-up remains over $500 billion, the Fed still has the ability to reduce its holdings on its balance sheet for some time. So they're also talking about reverse repos here. We should kind of keep an eye on that, because the Fed is talking about a line in the sand of around $500 billion until they may start to taper QT. Okay, so I think that's important, just that they're finally giving us some more clarity as to what this looks like. There is some chance that they could start cutting rates later this year and still be rolling off their balance sheet. And I think that's something that's becoming more accepted by watchers, particularly in the rates market. And we had another busy week and really day of Fed speak. Barkin, Goolsbee, Bostic, Waller, Logan, Daly, Kugler, all speaking or spoke today. Kugler's still on the docket. And Richmond's Fed President Barkin, who is a voter, said this morning it's too soon to predict when the Fed will cut rates, and noted there's no urgency to do so given prices continue to remain abnormally high. It's funny that he said prices. Most of these guys don't talk about prices. They talk about the rate of change. Typically, when we qualify inflation, we're talking about the rate of change. So it is kind of refreshing to see one of the Fed speakers actually talk about cumulative inflation rather than the rate of change. And we're going to get a text release from Kugler in about a minute. So that's going to be something that preempts their live appearance. Dow, S&P, and NASDAQ all up for a fourth straight month in February. S&P and NASDAQ ended the month at new record highs. Upside came despite the hawkish repricing of Fed pivot expectations. The market priced out 60 bips worth of rate cuts. And this is interesting. So you can see at the twos, right? You could see that kind of like going into this year, there was maximum optimism about the Fed's policy posture being more dovish. You can see it in Fed funds futures as well. And there was that opportunity to fade that when price began to reverse. And that was a pretty lucrative opportunity because it was pretty clear that unless something big broke, the market was overzealous in pricing the dovishness of this Fed. The Feds continue to push back. Now the rates market is getting closer to alignment with the Fed. But what's not yet in alignment is the equities market. It still seems a little slow to catch up if it's going to. All right, so some somewhat soothing commentary from Kugler, essentially stipulating that we dodged a wage price spiral, which is, it's interesting commentary given that the last wage growth reading we had was 0.6% month over month. If you annualize that, that's 7.2%, which doesn't suggest that we're in the clear 100% yet. So I would say one print is not a trend, but if we continue to get those prints of higher than 0.5% month over month wage growth, that does become a concern, particularly for the services industry and the price pressures that may pass through to consumers. So I'd say, making progress over the last year for sure. But, at a point of saying all clear, not so much. Particularly if, we see this sort of universal agreement that the Fed's still set to cut as we see the stock market near all-time highs, Bitcoin near all-time highs, housing prices near all-time highs, wage growth reaccelerating, and potential inflation in the pipeline from services PMI, where producers are saying they're paying higher prices, and then NFIB small business surveys saying that small businesses are planning to raise prices in the next 3 to 4 months, something like 36% of them, a growing number of respondents. And that tracks pretty well with CPI with some degree of lag. So I'd say, yeah, we've made progress on inflation. There's no doubt about that. The question is whether that progress will continue. And I tend to be driven by the data. And so I'm looking at some of this data that, has anywhere between a 2 and 6 month lag time and saying, maybe we should temper our expectations about immaculate disinflation until we have a little more encouraging data and we don't see any signs of reversal. So let's go back to the markets here as we get to the close. We've got about 27 minutes left in the trading day. For all the folks out there, I hope it's been a good trading week for you so far. We see buyers pulling up the point of control in ES once again. So that is relatively constructive. We're building some acceptance here at higher levels. NASDAQ doesn't quite look as good. The point of control is higher here, but it wasn't necessarily pulled up by buyers. It's been up there for just a little bit, right? Until like basically 250 or so when we saw that last run up. What I do like about the NASDAQ here, though, is it's consolidating. We can no longer say the microstructure is a clear downtrend. It's more of a market where supply and demand in the very near term is somewhat balanced, right? We're not making lower highs and lower lows as convincingly. This looks more like consolidation readying up for another move. And the S&P has a somewhat similar look as well. We'll zoom in a little more. It does appear to be even more constructive than the NASDAQ as we approach the close here. So, the idea that we could climb back up to that hot call level, not unrealistic. We did get back down to that warm call. We talked about that being a bit of a magnetic level earlier. We got a little below it. Now we're starting to climb above. Options, once again, kind of showing us the amount of influence that they have and also why these are important levels to watch in this market. Had a very interesting question from someone asking, historically, does the market tend to trend down when the Fed starts cutting rates? So the very simple answer to that question is yes. But I think context matters. So often is the case that the Fed is cutting rates because there's something wrong, right? There's either something slowing in the economy, the labor markets, seeing high rates of unemployment, or there's a recession, or there's some kind of financial crisis, or all of the above. So, it's hard to say that it's the Fed cutting rates that is the actual catalyst for the market decline, because then when we look at periods of time, albeit there aren't many, but when there were soft landings and the Fed cut rates, it was actually quite bullish for stocks. And so, you saw, because there was no real economic or financial system turbulence, that rate cut actually added more liquidity into financial markets. It made liquidity cheaper, more abundant. So I think context matters. It's really going to be about what are we looking at? What kind of environment are we in when the Fed is cutting rates? If we're in an environment where the economy is rapidly slowing and there's problems in the financial system, or really either or, then that rate cut could be something that actually scares the market a bit. Right? People could get a little bit more concerned about what does that mean? Why is the Fed cutting? And that could be seen as negative. But if they're cutting rates because they're like, hey, policy is too restrictive, inflation's come down, and we think that, we can kind of fly our mission accomplished banner, that could actually be bullish for equities. But I think it would be a policy mistake because I don't necessarily think all the catalysts for inflation have been resolved, and they may not be by this summer either. So my thought would be, context is key to kind of figure out where a rate cut may have an impact on equities. And, on the other side of it, we've seen the repricing of the Fed's cutting significantly. We went from like 150 bips to 75 bips over the last 3 months in terms of what the projected cuts would be for this year. And yet equities don't seem to care. You're really only seeing that pressure in the rates market, at least for now. So let me know if that helps to address your question. Yeah, you're welcome. Absolutely. That's a really good question. And, it's one of those where, like, if we just view it two-dimensionally, the answer is yes. But I don't think we can view these questions two-dimensionally because there's so many other variables at play. So I really appreciate the question. It's fun to answer questions like that because, we should challenge conventional thinking. We should look at things with a bit more nuance. So we've got about 32 minutes left in the trading day here. We can see the S&P 500 just pinging this point of control that buyers have pulled higher here as we approach the close. NASDAQ starting to look more constructive. It looks like the S&P is leading the NASDAQ at the moment because the NASDAQ is now starting to mirror that pattern of, starting to reverse. We had that period of consolidation. Now we seem to be starting to make a bit of a reversal in the microstructure. Russell still kind of meh. It's probably the least convincing of the three. Gold continuing to consolidate. But remember, this has been overall a pretty decent day for gold, right? Overall, we've seen a nice little climb here. Like, look at this from the open. Woo! That's quite a build. Buyers are able to drag that point of control up all the way to like 2094. Again, I'd love to see gold above 2100 to show extension potential for the metal, for the miners, and for silver. I think they're all coiled up and ready to run. They've been consolidating for a while. And I don't like all the gold miners. So let me be clear. Like for most of these companies, especially the juniors, they're hot garbage. So please be careful with what you buy where you trust your money, it's usually easier to get into a ETF that's well diversified or a senior miner that is better run. The junior stuff is almost as speculative as an altcoin. I'm saying that because the reality is a lot of these companies just set money on fire and overpay management, and it just doesn't work out so well. So be very careful in that space. I say that from experience, right? I've had some really great gold trades, and I've had some ones, and particularly in the junior miners, that weren't as amazing. So, be careful, be discerning. And if you're most comfortable just trading the commodity, that's fine. I would consider looking at like gold nanos and micros instead of GLD, just to get rid of the a disfavorable tax treatment, K1 schedules, and all that sort of stuff. But that's just sort of how I look at it. All right, crude. Getting back up to close to 80. Buyers have pulled that point of control up just to that level as well. We do see reasonably large levels of resting liquidity both above and below us here. This is a more robust and liquid order book for crude than we typically see. So we can see interest is growing again in crude. That is something that should be encouraging to all the energy bulls out there that have been waiting forever for this exact move to start to play out. I think there's a lot of energy stocks that are coiled up, if not already moving, and that's a sector where there are objectively attractive valuations. It's like gold juniors. You got to be careful with the junior energy companies. They're not as bad as the gold juniors, but be discerning. But for the energy seniors, your Exxons, your Chevrons, and others, there's plenty of opportunity in those. Those are some really well-run companies that are objectively cheap. Let's take a look at the twos here, and let's contextualize this with a larger amount of data. So we can see there was a pretty big move higher in the twos today. That's showing you that rates are coming down. And then look at this resting liquidity in the tens above us here, about 1,000 on offer. Right? Just a little ways above. That can be a bit like a magnet. I don't know this is going to necessarily play out today, but we'll see if that order is still on the books next week. We'll also take a look at the euro here. I'm going to imagine that the euro had a reasonably good day. Yep, look at that gap up and continued move higher. And then we'll go back to the S&P, which is now breaking above the point of control and heading back towards that most active call strike. Seeing crazy amounts of call premium paid today in the unusual option signal stream on the Discord. Just pretty incredible stuff overall. I mean, we're talking about like pretty much twice as much unusual activity on the call side than the put side. This unusual activity is qualified by, premiums that are large, that are significant, like over 100,000 as a baseline. And the biggest one of the day, I'm sure no one would guess this, it was NVIDIA, 1.18 million, targeting the 850 strike 2 weeks from today. NVIDIA has been trading so much options, like it's such a popular options trading vehicle that has become 1/5 of all premium traded in single stock options. That's more than like Microsoft, Google, Apple combined on a daily basis. And that's pretty incredible stuff. We've seen similar like that in the past. Tesla was once that stock. So, there's just so much interest and activity in NVIDIA here. And that's one of the tools that I also recently leaned into, was creating a tool to show the full chain and 0 DTE gamma profile for any optionable security in the US that's traded on CBOE. So, every Friday you can do 0 day gamma exposure on things like Nvidia or Tesla or Apple, of course, but you can also do full chain every day. And then every day you can do 0 DTE gamma exposure for SPY, Qs, etc., anything that's expiring on a daily basis. And it's all from a code base that I've been kind of iteratively improving, and now has reached the point where we have a number of different tools built on it. And in fact, this SPX options visualizer also uses an algorithm I vectorized that recalculates the gamma profile and positioning every minute. So it's pretty cool. It's pretty helpful. We have a number of different ways to display it, and I think that it helps to further illustrate the routine price impact that the SPX options trading complex, which again trades 1.2 trillion every day, exerts on the equity futures market, which trades a fraction of that notional every day. Now, March tends to be a seasonally bullish time of year. The NASDAQ has reasonable odds to the upside in March based on prior seasonal trends. 67% of the time, the NASDAQ 100 closes higher March than it started, with an average gain of 2.5%. So seasonality would suggest that we're going into a somewhat more favorable time of year. Now, I know there was a lot of discussion about February being bearish, but in actuality, February isn't really bearish as a whole month. It's really just the back half of February that has a higher potential of being bearish. But on the whole, February is up about 60% of the time. So not really a weak time of year. The weakest 2 months are actually August and September for the S&P going back to 2009. So context matters. And I think when we're looking for seasonality here, we're in a more favorable time of year for equity seasonality. Bitcoin seasonality is the best in February. We certainly saw that play out, right? I posted about that in late January when there wasn't nearly as much interest in Bitcoin, just saying, hey, we're getting back to a more seasonally preferable time of year. That was one of the reasons I got long Mara again, and made some good cash on that. I think this time was 30% on the trade, unlike 300% or close to it the last time, but still a good trade. And this has to do with the short squeeze setup, the catalyst in Bitcoin, then the seasonality was sort of the icing on the cake, in addition to the technicals that we saw in Mara. So I'm out of that trade now. Actually, it's kind of funny. Folks that look at the trade ideas room probably saw that I took off my core at like the perfect time. And I am not the type of person that is just like calls tops. That's not how I do it. I just try to capture the bulk of the move. But I took my core off at 33.08. So that was kind of the top of the move. Wasn't intentional, just sort of happened because I saw some things there that said, hey, this could be a heavy area of resistance. There's a lot of supply up here. I don't want to necessarily, keep my whole position on. So I got out of my runners when it kind of told me, okay, this trade's done for now. That doesn't mean that Mara is completely done. I know some folks are excited about it, but the way I trade squeezes, I'm very nimble. I'm in, I'm out, and I'm moving on to the next. And so I traded that one. I made some money. That's good enough for me. And I'm looking for the next opportunity, whether it's a squeeze or just another type of swing trade. But most of my trading is swing trading. Most of my trading is over a time period of weeks and months. And it allows me to set a trade, put a bracket order in, maintain it as I need to, but not have to pay attention to every single tick all the time. I do some day trading here and there for sure, but, it's not quite as active as some folks. Some folks are very, very active. They love it. They scalp, they kill it. And that's awesome. I respect that. Hats off to them. Just, I don't have the attention span for that. I more want to get in, get some ideas and then put them on when they're appropriate for the swing trade. So I set alerts, and then I don't sit there and watch them that closely. I put my bracket orders in, I govern my risk, I set alerts on those. And when they clear out, either from, capturing reward or realizing risk, max risk, and getting stopped out, I move on to other opportunities as they arise. And when a trade doesn't work out for me, I don't look back at it and want to revenge trade it. I look for a completely different opportunity. For my own psychology, for how I'm wired, that helps to keep me out of trouble. I've seen folks get hurt revenge trading. I've revenge traded in the past and gotten hurt. I don't want to do that again, so I just move on to the next. And if it's a winner, I do the same thing too. Now, I'll come back to winners. I'll revisit them, but I don't just come back right away. You know what I mean? If I'm out, I'm going to be out for a little bit, like I was with Mara. I was out, I think, for at least a whole month on that one. And yeah, the crypto space is very interesting right now. There's certainly a lot of liquidity that moved into Bitcoin and Ether. You know, the ETFs have been a powerful catalyst there. There's the halving in Bitcoin that's expected to happen around April, which essentially just drops the amount of supply that miners can bring into Bitcoin by about half. Right. So that's another reason I was actually a little hesitant on Mara. I know they have plans to work around this, and they've, done some restructuring and raised some debt. But a lot of the miners are going to be in somewhat of trouble after the halving, because it's really going to hit their revenue. So for me, that was another reason that I'm like, okay, I know this space enough to know that I don't necessarily want to be in post revenue compression for companies that are already unprofitable as it is. And I could be wrong. The thing could keep running, but the way I trade it, the signals that I had to exit were all fired off. And I was a little more hesitant because of that halving, because it's a great catalyst for Bitcoin itself. But for all the crypto companies, the miners, not so much. So we're just about 20 minutes away from the closing bell. Let's take a look at some of the headlines out there. A lot of headlines from Kugler, but we already kind of talked about that, so we're not going to rehash that again. 73 counterparties took $441 billion at the Fed's reverse repo operation. It's kind of funny that basically we were told what is the level to watch for as the line in the sand in reverse repo is around $500 billion, and now we just went below it. Oh, gosh. If you tell the folks that would benefit from less QT how to get less QT, they may manifest that outcome. So we'll see how this plays out. I think they're going to look for a lower level than below 5. I think personally it's going to be closer to below 300 billion in RRP, but we'll see. We do get the Fed's March survey of economic projections at their Fed meeting this month, which I think is going to be very interesting. Last time they were talking about upgrading from 2 cuts to 3 cuts this year. They did talk about, economic growth being slower than what it actually turned out to be. So we'll see how their model looks at inflation, economic growth, and the dot plot, right? The dot plot being the sort of polling of different members at the Fed as to where they see rates moving. Right now, though, we're pricing in about 3 cuts this year to start in July. Got some pretty significant interest in meta calls here at 500. Let's see. $520s and $525s expiring over the 2 last Fridays of March. Someone just put in, or a group of someone's just put in about $450,000 of premium into those calls. These just came across maybe a couple minutes ago. And looks like we're in for another week of lots and lots of Fed speakers next week as well. They pretty much, it's almost become like a perpetual reality show as the Fed's opinion churns. Every week until blackout, you just have these guys coming out and telling us everything that's on their minds. And it's a little much, I gotta say. So we see price kind of coming back down here. We got up to the point of control in ES. We're now being kind of reflected lower after that peak above. And we still see interest building at these two levels, the hot call and the warm call. If we zoom out a little bit, we can also see the warm put and then much lower the hot put. And we can see how much more interest there is in these calls today than puts. That's just another thing to look at that's pretty important. That asterisk by the hot call telling you that the put call ratio favors calls. There's more calls transacting today. And that is the most active strike on the entire SPX options chain, because this tool focuses on all SPX options. It's not just 0DTE. It's everything on the chain, all about 10,000 contracts reevaluated every single minute. There's nothing like that out there. That's kind of why I built it. I was like, well, can I buy something like that? Couldn't find it. So it's like, all right, then I'll build it. And I've been testing it for a few months and then finally perfected it. And now it's out there on the Bookmap Marketplace. Of course, you got to have Bookmap. But I think it's worth it if one is, actively trading the S&P. Otherwise, unless you're trading things that are highly correlated with S&P, maybe not as worth it. But for me, I look at the S&P as kind of the center of the market. And so I like to pay attention to it, even if I'm not actively trading it, because it has such an enormous influence. So many stocks trade with high correlation to S&P, so many whole sectors and industries. Someone asks me, what is the definition of hot and warm call? Great question. The hot call is the most active call on the entire SPX chain. The warm call is the second most active call on the entire SPX chain. And that same is true of the hot put being the most active put and the warm put being the second most active. Okay, so it all is terminology just to indicate like levels of interest, sort of like a heat map that we see in Bookmap. And so the value of that is seeing where there's a lot of interest in transacting. The more interest there is in certain areas to transact in the market, the more likely it is that we see some interaction, right? Where spot pricing starts to move to some of those levels. So we see that interest, for example, growing at the hot call. Wouldn't be terribly surprising if we start to push up above this point of control level here, that we could gravitate right back towards it. And that would be sort of a reasonable extension to take some profits. So let's zoom out a little bit. We can also see this call wall. This represents SPX 5150, where it's really the largest area of net call interest on the entire options chain. So it's likely to be an area that's kind of important for market participants. And I've been talking about, 5100. We close above it, we build interest above it, whatever the case is, we have room to extend from there. And that's exactly what played out today. We got a pretty convincing move above 5100, and now we're pushing right up towards 5150 SPX, almost as if options have a really big impact on price discovery in ES. Let's look at the NASDAQ here. Chopping along. Similar look as the S&P. It's almost like the consolidation pattern has expanded into a larger range overall. We did get a higher low here, but we haven't had a convincing higher high. Russell, pretty similar look there as well. And gold, as we get closer to the end of the day, just kind of hovering around the point of control. Now, the pits have closed in gold. They really close around, I think, around 2 o'clock. So not much to say there. Or in crude, which is settling lower from its recent highs. So we'll go back to the S&P just as we have about 12 minutes left in the trading day. Remember, the last 10, 15 minutes tend to be the most volatile. So for folks that are managing their books and their day trading and whatever, it's a good idea to kind of think about how you want to square your positions away. Do you want to carry these into the after hours session where things get less liquid? Are you comfortable with that risk over the weekend and paying the margin cost to carry it? Or are you more likely to want to close out around an extension target like that hot call? All up to you all as to however you want to do it. But when I look at stuff like this, that for me, if we get to that hot call and I was in long S&P trade, I'd be out. Whether it's SPX options or ES or whatever, because there's just not enough time left in the day to say there's a high likelihood it goes terribly further than that. We did get some updates on positioning from CFTC. We've got increases in short positions in some of these areas, including equity futures, probably hedges there. So equity fund managers cut S&P CME net long position by 5157 contracts to 942,000. Equity fund speculators increase S&P 500 CME net short position by 14,679 contracts to 434,512 contracts. And we got some trimming across Treasury short positioning across all the durations. Yen short positioning is also increased. I'm in favor of looking for a reversal, honestly. I think the yen is a little crowded of a short trade now. It's starting to see some resistance up here. If we see a convincing reversal, I'd actually want to go long yen for the counter trend pop. Be a short, agile trade, not going to be a long-term swing. But I think there's some room there just because it's getting a little bit crowded. Maybe the Fed meeting would be part of that catalyst, particularly if they come in more dovish. Euro net long positions about 62,854 contracts. And we did have a decent little iceberg go off there where there were some buyers into that weakness here as we enter the last 10 minutes of the trading day. About close to 1,000 contracts on the buy side. You can see it on the subchart indicator here. You can also see it on the radial, where we're tracking that flow over the last 30 minutes. You also saw there was a decent amount of stops triggered there on that little move lower, but below that point of control, about 181 contracts pushed out to the sell side that were long. That's the other thing I like about Bookmap overall is you can see so many different interesting and important elements of the order flow. A lot of other software is sort of built to guess about what's happening with icebergs and stops, but Rhythmic actually shows you what is really happening with icebergs and stops, which is more helpful than guesswork. Got about 8 minutes left in the trading day. I want to wish everyone a happy Friday. I hope you had a great trading week, made some money. If you had some losers, take note. What happened? Why did it happen? And try to figure out how you can avoid such outcomes in the future. And the same is true of winners. If you had some big winners, kudos. But figure out how and why so you can repeat that process, make it more consistent. The biggest thing about trading is it should be kind of boring. There shouldn't be a lot of emotion involved. Successful trading is run more like a business. You're buying inventory cheap, you're selling it expensive, or you're selling expensive inventory and buying it back cheap. That is the crux of it, right? And you're just basically trading a two-way auction for that accumulation and distribution of inventory. Are you always going to be right? No trader is always right. So it's also about cutting those losers early and staying with the winners as long as they fit your system. And if you don't have a system, you shouldn't be trading. If you want to learn more about all this, the psychology of trading, trying to improve your consistency and everything, check out my YouTube. I've got a free video for everyone. It's at the top. My YouTube is linked on my Twitter profile, or if you're on the YouTube, you can check it out right there. But the psychology of trading is really important to your consistency, to your survivability. This is not all about short-term gains and getting rich overnight. The people that project that kind of stuff generally blow up. The reality is trading is a business. You need to remain solvent to stay in business, and that means it's much more about how you perform over long durations of time. And if you understand your system and you can be consistent in it, then you can have more predictable performance. But if we're just blindly guessing, or worse yet, we're just following other people and not doing our own work, it's very hard to gain any level of confidence or consistency. Let's take a look at the NASDAQ here. Just the same look, just really consolidating, just chopping sideways as we get into the close. So it looks like that's kind of the expectations that we have from this market. Not much more price discovery. Now, the last 5 minutes could be a little more interesting. That's when really all the orders that are going to come in for the rest of the day kind of come in a rush, so it might be a little bit more choppy. But that accumulation, that big iceberg, which ended up being calculated about 1,000 here, that was reasonably large, right? That helped to probably discourage further selling, because that's significant absorption. And you can see that right on screen in real time as it's happening. And then the data that's displayed is actually based on real icebergs as they're qualified from order flow. So I find that to be really helpful. There's not really a lot of other software that qualifies it. It's more like guesswork, like, oh, look at this really large area in the auction. Maybe this was an iceberg. We don't know for sure, but in this situation, we do. And if you see large amounts of icebergs into, say, for example, a decline, and there's lots of accumulation, typically what you see is that decline slows and then it begins to reverse, right? Particularly if that decline was a bit of a stop run, and then you got folks aggressively buying it that are less price sensitive and less time sensitive, that typically will scare away the short-term momentum shorts, and you can see reversals into that. So you wait, you see the stop out, you see the icebergs accumulating into that, you see the price reversal, and you have some confidence this could run. Right? We didn't see that just there in a nutshell, right? That 1,000 isn't enough to say that alone, but it's not bad, right? It was encouraging. So the play I'd be looking for would be a little bit more than that, but nevertheless, here we are at the hot call, almost as if by magic. Again, almost as if options have an influence on price. So the most active call strike today on SPX is 51.40, and that translates to the level you see on screen around 51.47.25 for ES. So there is a delta between SPX and ES, right? The spot cash SPX is always going to be just a bit lower, anywhere between, like, you know, well, in the current regime, like 50, 60 points or less. And that delta compresses as we get closer to contract roll, which we're coming up in about 2 weeks, right? So the delta will fade and fade and fade to lower single digits until it's appreciably even. But that's why I mark things on the screen the way I do. I recalculate the delta between SPX and ES every night, and then I display the numbers on screen based on the delta so that you're seeing the ES numbers in Bookmap, even though they're translated from SPX levels. So hopefully that helps to satisfy your inquiry. But yes, the most active call strike on SPX is 51.40. And that is just where price pinged. That was a perfect place to exit. Call it a day. That's what we were talking about a little earlier. And yeah, I mean, now we've got 2 minutes left in the trading day. So, you know, if one didn't exit there and was looking for higher prices, that's probably not the best strategy, because now there's, you know, based with time as a probability factor, there's a lot less of a probability that that plays out. You know, you've basically got 2 minutes for that to happen again. Yeah, you're very welcome. Great question. So someone asks me, that I mentioned that I like to trade and watch SPX, or if you like to trade and watch SPX, then Bookmap is great. And they said they missed why I mentioned before that thought, and that thought grabbed their attention. So I'm sorry I didn't unpack that question very coherently, but basically they're interested in me explaining why I think that Bookmap is a good way to watch, say, ES and SPX. And I think the reason for me is that there's a lot of value knowing where there's resting liquidity on the bid and offer, There's a lot of value in seeing the stops and iceberg flows and how they're affecting futures. And then there's even more value in having the SPX options visualization so you can see the options trade and how it plays into the convergences that you might see with the most active levels of flow in options, the areas of the highest interest that we see in gamma, and then how that impacts price discovery. So, hey, folks, if you were waiting for that hot call, you got one more chance at it. We're just about less than a minute away from the close. So, there you go. That was the second less likely chance to hit that level. We got it. Now we're going to close. I hope everyone's had a great trading week. I really appreciate you all tuning in. This has been a lot of fun. I'll be back streaming regularly, trying to share more information and all that. And I'm going to be doing another little presentation here with a group called the Trading Panel, where we'll talk a little bit more about swing trading and our own approach to the market. So thanks again. Appreciate it. Catch my work at Traderade. Follow me on Twitter and YouTube if you're interested. And I'll be back. Have a great weekend.